After 18 years in commercial real estate, from grocery-anchored retail to multifamily and back again, Evan Polaski has seen how investor behavior, risk appetite, and deal structures evolve through every market cycle. And in this episode, I'm sitting down with Evan, Director of Capital Raising at Blackgate Partners, to unpack what it's been like managing investor relationships through the 2008 crisis, what he learned at Ashcroft Capital during the multifamily boom, and why he's betting on necessity-based retail today. You'll hear, LP behavior changes in bull versus bear markets, the difference maybe between retail and multifamily operators and their LPs, and just lessons learned from raising over $500 million in capital across his time as investor relations. So with that, before we dive in, if you're serious about becoming a better LP, mark your calendar for the Best Ever Conference happening February 18th to the 20th, 2026 in Salt Lake City. I will be there. I will be teaching an LP-focused workshop, and it's one of the top events in the country for getting to know, meeting, and learning from different operators and high net worth investors if you're a passive investor. And so tickets right now are, I think, just under $700, and they continually go up. I think last year they went all the way up to $1,200. So if you're interested in going, I recommend grabbing yours now and go to thebesteverconference.com and use the discount code podcast10, like the number 10, for 10% off. And with that, I would love to welcome Evan. Welcome.
Thank you, Pascal. Glad to be here.
Yeah. So I would love to kind of start out with, you joined real estate right before 2008 crash. Take us back. What was it like from the inside? This was your first real job in the industry?
It was. So I took the long route through college, graduated from the University of Cincinnati business program with a focus on finance and real estate in June of 2007, and started my first job July. I lined it up basically right as I was finishing school. It was interesting because when I came in June of 2007, very high spirits, still kind of running up the, nothing's really shifted yet in any meaningful way from an economic standpoint. The company I was working for had just closed. In 2004, they raised their first institutional fund using a placement agent, brought me in as well as other executives on the team to do that in-house for a second institutional fund. So loved it, learned a lot, went back to our first investors. I was learning everything from the sales focus to how a P&L and a balance sheet and a statement of cash flow all interrelate, because my most direct boss was the former chief accounting officer. As you see with a lot of companies, kind of those head accountants move into IR roles because a lot of investors want to know about the financials. And so just kind of taking it all in. But again, it was great. A $90 million investor in our first fund came back for $100 million. Another institutional LP came in, I think they were at $40 million in the first fund, came in at $100 million, brought in a $40 million referral. Like, just the power of institutional money is insane. So we're getting a bunch of recommitments, but it does take time. And what we were noticing through that time as markets were starting to slow down, Bear Stearns hadn't gone under, Countrywide hadn't gone under, but things were happening. We raised all of our foreign money. Those were the three investors I just listed. Three outside investors, $240 million. That was supposed to be our whole non-US allocation, but we had to be a domestically controlled REIT, diving too far into the details. So we had to match it with $260 million, because we were trying to do a $500 million fund of domestic money. If we didn't raise it, we could only call, proportionately those 240 up to a point where they say 49% versus 51. So that's where we really hit the wall. Got a couple recommitments from domestic guys right off the bat. And then it was just brakes slammed on the wall from the capital raise point first. And what we were hearing over and over and over again was it's the denominator effect. We can't write any new commitments because you have all these private real estate funds that you're in. Those operators aren't writing down their deals. We have a stock portfolio that's down significantly, and we have to allocate 20% to real estate. Well, when a big slice of your portfolio collapses, all of a sudden that denominator gets smaller, and your real estate that hasn't been touched, realistically probably should have been written down, but private real estate, some of the pros and cons of it, it wasn't. So it looked like they were over allocated to real estate. So not only could they not commit to our fund, but it was, just a shift. And they were actually, you saw a big secondaries market pop up then. This was 2008, as all these institutions had to unload these private placement commitments. So it was a quick kind of roller coaster, but it was only the up and down version. Like, oh, I'm learning everything. I'm doing great. This is fun. And all that is still remains true to, what was it? It was May of 2009. Like, kind of watching my bosses come in. There was a director level in between me, the analyst, and my VPs. And I happened to see out the window, sat in a cube, and I kind of glanced out, and they're walking back in from lunch. Like, my out-of-town boss, my direct boss, and the director walking in, like, they were just somber. And then next thing I know, like right after lunch, called into my office, you're smiling. Evan, we got to let you go. Like, we're laying people off. And, my take was, I understand it. It sucks. But it was retail in 2009 by that point. And, occupancies were going. It was a little bit like COVID, obviously totally different in many ways, but similar in the sense of just tenants weren't paying rent. If rent doesn't come in, not only do investors not get paid, but payroll doesn't get made. And it all starts with that tenant. So, interesting times, but definitely have positive experiences about it because it was a pretty large company. Again, they were raising institutional money. They had 250 assets at the time, 230 employees, so it was, you had all those corporate structures. I got to sit in on DD meetings with some of these, huge institutions, 2 straight days, and they're grilling the accountants about, grilling's an overstatement, but like, it was a lot of time with the head of the accountants, the controllers, the CAO, some of the fund accountants of, anti-money laundering stuff, like boring stuff that no syndicator ever wants to deal with. But that's where these big checks come from. Like, it is, how can we be sure that your property manager isn't going to submit an invoice for $50,000 from a property we own and get it paid, and it's actually going right back into their own pocket, and they're dipping out and disappearing. It's a lot of that risk mitigation type stuff. So positive experiences and, also negative experiences that still sit with me.
Yeah, and it was a
But I loved
specific
it.
time. It was a specific type of asset class. So walk in, it's retail or grocery. Talk to us about the asset class.
They're grocery anchored shopping centers. So that is their core business. At that time, they had a couple ancillary lines that still involved retail, but the institutional money, the main portfolio, the main funds they were raising all went into basically just your Kroger anchored shopping center, your Safeway anchored shopping center, your Publix anchored shopping centers. And that very typical lineup. You got a local Chinese restaurant, a local Mexican restaurant, maybe a pizza place, a cell phone store, Great Clips, a dress bar or some kind of discount fashion type place, and rinse and repeat over and over. But they were acquirers, so they were not developers primarily. They'd done a few developments, but it was the story that I was always telling was it's the first bill people pay. To relate it to today, and whether we're officially in a recession, not in a recession, what that is, doesn't matter. It's, look at all of the affordability topics that have gotten the most recent round of politicians elected, and even the last presidential election. Like, it was affordability. And having worked in retail and multifamily, like, those are both very important. Retail nuance as to the importance, but if I only have $50 in my bank account and I'm coming up against a grocery bill or my rent payment, I know which one I'm paying, and I'm going to figure out the other one. And it's not the rent. for my apartment. I don't want to go homeless, so I'll pay that before I pay my car bill or cell phone bill. Grateful to not be in that situation. But people are going to eat first. And so that was a lot of the story that we were telling our investors as we're pitching these endowments, these institutions. Just, a lot of research into it to basically get to Maslow's hierarchy of needs. Like, food comes first, shelter is a very, very close second, and then there's kind of everything else.
So that was also a firm where, we're talking a lot about raising the institutional dollars. I'd love to understand some of the dynamics of, were you accepting retail capital? I imagine at that scale, the company becomes so big, or they need to raise so much money that it doesn't make sense for them to deal with $100,000, $50,000 checks like you might later at the other firms that you worked for. Talk to us about that dynamic.
So it was definitely different. Now they had a group of legacy investors. So even when we were raising this institutional money, it had to be structured as a REIT so it was not the REIT that everybody thinks of. Granted, they are publicly traded now. You can go on to, I think they're on NASDAQ, but one of them, and just, plug in their ticker and buy their stock. But back then they were not. So I always educate people, like, a REIT does not always mean that, the publicly traded, that's what you see. It's a tax structure, and you have private REITs, LP REITs, whatever. So kind of the first retail raise that I was really involved in was for the REIT qualification. And they basically, so they have what do they have? 15 investors, 10 investors in like the institutional money, the main source of money. But to qualify for a REIT, you have to have, I think, at least 100 investors. So we went to our legacy investors, and I forget what the share class size was. It was a reasonably small number, $10,000 or something like that. But it was raising $10,000 increments from, I think we had to get to 105 for our compliance attorneys to say, like, okay, you don't want to stop right where you need to be. You want to, like, have a few extra in case something happens. I couldn't even tell you the structure of that. It may have been more like a pref equity, just a flat 10% return for these $10,000 shares. But that was kind of the first one. And they did do some ancillary business lines. As I said, their core business was the grocery anchored shopping business, but we raised 2 strategic investment funds. We raised a single tenant net lease fund. So all retail oriented, but things that fell a little bit outside of the core grocery anchored shopping center business. And we always did those with these legacy investors. So it was retail money. It was $50,000, a lot more, $250,000. But just given the success they had shown their investors over the 20 years up to that point. But it was just a different dynamic. It was a quick decision. It wasn't investment committees. And to translate that to a little bit of what I've seen over the last 6 years, where I've basically exclusively focused on the retail side, it's like anything. There's no like silver lining. The institutional money is great if you get it, because you get one check, $50 million, done. But if they pull the plug at the 11th hour, they're not out anything, maybe some due diligence costs. You're the one stuck trying to buy a property and going hard on earnest money and everything else. The flip side is, on the retail side, like you said, you need some really good systems in place to manage, 300, 500, 1,000 investors, and the quantity of questions that they come with, and, the issues you're talking about with them. But on the recruitment side, there's a little bit of carryover. Everybody wants to understand the general risks, and you're pitching them on why grocery anchored or multifamily or industrial or whatever you're selling is, a solid investment class. And I always focus on the risk adjusted returns. Here's how we're mitigating risks, and we're getting all this upside. And hopefully we can find a little bit of dislocation there, or seed a little bit of that into your mind to get you over the hurdle. But you're definitely making a bigger impact. There's a more direct feel when I'm dealing with, say, you, who wants to invest $50,000 of their own money to set up your retirement and put you in a better position for any number of goals that you might have into the future. And the trade-off is, like, that's very fulfilling. until it doesn't go exactly as planned, or much worse than exactly as planned. And then you're answering to people about why you ruined their potentially. Hopefully nobody is or ever has to have done that, but
I get it. No,
it's the same direct connection. It's the double-edged sword of it.
Yeah, I imagine also the questions were very different. So take us into, you took a little hiatus. You owned a CrossFit gym.
Mhm.
I don't want to hop too much into that, but eventually you came back and got into multifamily with Ashcroft Capital. And so there you were dealing with a very different type of asset class and a very different type of probably all retail. Or maybe the dynamics have switched. Maybe there's less institutional. And I imagine, talk to us about the difference in how an institution approaches a deal versus an LP.
Yeah. So institution at a very high level, institutions are 100% risk management. They almost don't care about IRRs. I won't say they don't. You need to outperform, but they're long-term investors. They're doing this all the time. From my experiences, they're not looking at, I invested with Evan at this company, or take my name out of just this company, and they lost my money. They lost 30% of my dollars. I invested $100 million. I only got $70 million back at the end of the day. They're not going to be happy about that, but they're also going to be comparing that to every other group that they invested in that vintage. So they just have a bigger universe to compare to. So I might be the best performer at having lost 30,000, 30% of their investment, because everything else they did lost 80% or all of it, hypothetically. So that's a big, just kind of mind shift. And I think that's where a lot of LPs today, as one myself, it's kind of I can't totally judge just this investment that I made in 2021 because the market dynamics were totally different. Now, internet's a great thing, and I'm going a little bit on a tangent here, but I can compare somewhat through different avenues where people share information. I mean, as simple as Reddit, people are posting some stuff on there. I think there's more robust databases out there that you could touch into.
People talk about it on 506 Investors Group, Passive Pockets, Best Ever, all these different forums.
Yeah, so you can find it. And so you do have some more comparison points there. So diving back to your original question, institution, I feel like really focus on the risk management first, and then potentially chase returns and kind of fill an investment thesis. Retail investors chase returns first, and then consider the risk. And I will say, in all reality, as a lot of people probably are, for what it's worth, not very well. Again, myself included. I made some investments in 2021 and 2022 that I'm, in my mind, I've written off. The assets are still owned. They might somehow come back and not be a complete write down. But in my mind, at least that way, if I only get 10 cents back, it's a win.
Yeah.
As
hard
bad as
time
that sounds.
to invest.
Yeah. But it is, I got swept up in it as well. I got laid off in 2009 because a group, was buying when they had access to money. And these are great operators. I don't discount that. The company I was working for, like I said, is a publicly traded company now, considered one of the best in class for their in the grocery anchored shopping center space. So this isn't a intended to be any type of dig on them, but it's just in reality, there were some market shifts and there's some aggressive assumptions. And it's always easy to say things were aggressive when the market collapses right behind it. But I lived that firsthand. I lost my $40,000 a year job right out of college because of it. So that, as I mentioned in the opening, burned me and kind of stuck with me. And still, come 2021, it's man, why am I holding on to these rental properties that my rents are growing, but my appreciation has grown 5 times as fast. So every year I have a lower return on equity. And if I refi tap into that equity, that's great. But then I'm so cash poor that if the first repair, if I invest that money somewhere else, now I don't have any leftover cash flow for the new roof when that comes to be needed. So it's playing that balance. I ultimately sold a bunch of my properties, did really well on them. And, it was looking at some of these syndications saying, yeah, they're paying, maybe they're paying 4% year one. That's still better than my return on equity now. And it's going to grow to 7%. And you get wrapped up in it, as a lot of people do. So again, it's that when I see LPs, they're like, it's your fault. Whoever that syndicator is, you lost all my money. I'm like, I was working the space too. I felt like I was being honest and explaining everything as best I could at that time, and an LP losing money myself in those deals, or several of them. That it's like, yeah, there's some issues that we'll learn from. There's also nobody reached into your pocket and said, Pascal, you got to, like, if you don't write me a check for $100,000, it's over. Like, I don't, whatever threat I'm going to make. It clearly was never that. It was like the financial crisis with the subprime mortgages. Yeah, some bankers lied to people, and I feel for those people. But if you go into a bank with no income and no job, and you're wanting to buy a house, there's a little bit of the shame on you. Like, not 100%, but it's not zero either. So I tend to have that kind of mentality, even with my own investments. I should have known better. Some things I'll learn from and not repeat.
I love that you brought this up, because I think this is when I worked at Techstars, the venture capital firm, we had this saying that we would tell all the founders going through a program. So, these startups are sometimes asking themselves like, oh, hey, like right now, if it's a successful startup and it's doing well, oftentimes when they raise a round, they will be oversubscribed. More investors want to put in money than they were originally planning for. So if they were planning on raising 3 million, maybe they end up raising, maybe they have 2 million of additional interest and could close 5. And the response that we would give the founders, or that I often heard through the organization, was drink when served. Because it's like, you don't know when it's going to be hard to raise capital again. I think now that I kind of sit on the outside and have invested in a bunch of these deals, I feel very similar. It's like these companies are designed to do one thing, and it's whatever their strategy is. And they're going to do that strategy in good times or in bad times, because that's what their company is dedicated to. For them to pivot into something else would be so much more difficult than to like continue, with all the systems and the people and the knowledge that they've built up in this thing. And it's really, I think that's just a reality of how the world works. And it's more of a reminder that we as investors, it's our job to make the decision of whether it's everyone's going to sell their asset class, that it's the best thing since sliced bread, and that now is a great time to be investing. And so it really is, I think, on us to do that. There are many operators that said they were pencils down and that they weren't doing as many deals, but I think that's an important note for just like as an LP to think about. And I imagine that dynamic doesn't change over time. I mean, you've been doing this for a while, and I imagine you keep saying that issue.
It doesn't. So a couple things with that is, my role in a GP, and this came up actually on Passive Pockets just the other day. Somebody called out, they were reviewing somebody's PPM, and it specifically said, like, I'm going to misquote it, but we are not a fiduciary to you. And it's like, no, we're not. I'm not a licensed individual. I don't have to be, because I'm only raising as an employee of the company that I'm raising for. I'm not doing fund to funds. I'm not doing co-GPs where I'm not really an employee of anywhere. I'm just collecting fees off of stuff. And then in that case, I don't want to say it's right or wrong, but the very clearly on the compliance side is they are a licensed broker dealer who can collect a commission on every sale they make. And they could be selling syndication positions. They could be selling stock options. I don't know, like whatever else they sell, they get commissions. So we're sales guys first. We are here to raise money. I mean, my title at Blackgate, as much as I'm sometimes like, change it to investor relations, which is a part of it. Like, my job has been to raise money for the last 6 years. And the relationship side, from a purely business perspective, is irrelevant. It is bring checks in the door to fund our deals. Like that is any IR person's, that's any founder's job. Now, this is where it gets really hard to figure out, because there are the groups that have been pencils down. We have our boxes, and if it falls outside that, when multifamily deals are trading at 2.5 caps for a 1970s constructed property in South Arlington, not bad, but not the best neighborhood, and it's going to trade at $400,000 a door. Like, no, there's no, in hindsight, there's no world that makes sense, unless rates do stay zero forever and rent growth continue at 10% per year every year. But from an LP's perspective, think about that real long. When's the last time you got a 10% raise? Oh, and you're a professional who makes good money, because presumably you're an accredited investor if you're listening to this, or close there too. You have money to invest. Think about who the real renter is. $40,000 a year. You think McDonald's is going to give them a 10% raise every year, year over year, forever, while these rent increases need to go at that rate? So you have to dial back and not get pulled into the optimism. But then you get into the marketing side of things. Like, there are some groups that I've heard were, from the outside in, I truly believe they were disciplined. They were pencils down. They were not buying. They had all the access to capital in the world. There's the other ones that I hear that I'm like, that's a good marketing spin. You were pencils down because you couldn't raise money. Like that's, in my cynical LP brain, where I'm looking for the fault in everything. Try not to live in that brain too much, but it is kind of a little bit of my natural inclination. It's like, that's why you did that. There's a syndicator out there who's like got all this praise because all he bought was fixed rate loans in 2020, 2021, 2022. And I'm like, again, pretty sure that wasn't by choice. It worked out, and I'm not going to discount like the performance there, but it was because he was having to buy deals with loan assumptions above market rates, because that's all that was available to him at that stage in his syndication. It's where my brain goes. So you have to watch out for that marketing spin. Like, it is needed. It is required in this job. We're looking for the best reasons to buy this deal. First company, the chief development officer. I don't know why I was in there. Like, this wasn't some meeting that a low-level analyst was getting called into. It was the CFO and the chief development officer. And the chief development officer looks at the CFO and goes, "You're a dream killer, and I'm a dream maker." But like, that is most syndicators. Most syndicators are going to see all the positive in deals and be a little blinded to the downsides, because they're going to be realists, but they're also going to see like, yeah, like, this is a deal I want to buy, whether it's syndications or not. If I find a house I want and I can afford it, and I'm shopping for a house, like, I'm going to find a reason to buy it. Same with the sports car, and justify it in my head. Like, well, I did really well this year. I should invest this money, but that 5-year-old 911 looks really nice. And like, that's a bad example, because I would not only not get the car, I'd also lose my wife. So bad choice there, but you get the idea. Like, you can justify it in your head, and you're going to find all the upside as to why you're going to buy that deal. So that's another one. And I had a couple more, but I went off on those tangents. So now I'll jump back into them, come back up.
So you've now been in this role across 4 or 5 different firms.
Mm-hmm.
Talk to us a little bit about, I want to understand, first off, from the investor LP perspective, are there differences between how retail or institutions approach the asset class? So you did retail, grocery shopping anchored retail. You did a multifamily at Ashcroft. Then you were at Axia, and now at Blackgate. Tell us about the difference in asset classes and how LPs approach, maybe ask different questions. Are there different risks people think about? Yeah.
There There are. Again, most high net worth individuals are going to be shopping returns first. And they're going to invest in something. In my experience, a lot are going to invest in things based on referrals. And it typically comes to it's not so much the asset class. So at my current role, even at Phillips Edison years ago, the grocery anchored shopping center company, it was lots of friends of family because less people kind of wrap their heads around retail. Multifamily is a pretty seamless shift because it just flows from, oh, well, I'm going to go I own this house. I'm going to go buy a single family renter. Okay, well, like that went well. I'm going to go buy another one. Okay, like now I have two. I'll bet it'd be faster if I go buy a 4-family. And like it just kind of has that progression, that line of progression that goes up into, okay, I can't buy that 40 unit because I don't have enough money or I don't have enough time. But I see how this could work. And like it just, whether they're trying to be active or move passive, it just kind of flows a little bit better. Retail seems to come out of left field. And there's pros, like everything, there's pros and cons to it. I love it. I just post on LinkedIn recently because it's like, at the end of the day, it's what I use. I don't live in an apartment. Blackgate does have an office in Columbus that I'll go into periodically, but mostly I work out of my house. So I don't have an office. I don't use self-storage. I don't go to the RV park. I don't own an RV. Like all those things was like, okay, like I kind of understand the fundamentals of them, but I go to Starbucks, not super often, but twice a week. I will pick up lunch at Chipotle or pick up dinner at Chipotle. I will go to, whatever the quick serve restaurant, the Euro place I love. Like retail is the place that I'm interacting with in terms of real estate primarily. I've got 2 small kids, so like I'm not traveling a ton. Yeah, I'll stay in a hotel, but the biggest piece with it is I think people, it's just different. It's not really something they've thought about. Now, where I love it from an investor standpoint is you have longer term leases, like typically 5 years plus options, if not much longer, depending on the actual tenant. From the approach of like, when should we buy a new asset? So Blackgate just bought, probably within the last 30 minutes, I'm waiting for the notification, but my notifications are off, that we closed on a deal in Minneapolis, outside of Minneapolis. We've never invested in Minneapolis. We invest in the Midwest. We have Columbus, Cincinnati, Chicago land area. But you can count on these deals because you do the demographic reports. You look at the traffic counts. You look at the access. But more so you look at the tenant base and you go, Chipotle's in there. Chipotle is a multi-thousand person company last I checked. And they've got teams of real estate people as to where they're going to do their site selection. So a little bit different on the development side. We don't do development. But that's what I love about it is like you can kind of go in with some security. Then the leases are longer term. You've got triple nets, which I know if I'm going to compare to other asset classes I've worked in, real estate taxes go up. That's a pass through to the tenants. Insurance goes up. That's a pass through to the tenants. Now I don't overly it helps buffer because at the end of the day, your tenants are businesses. They're either going to make a profit or lose money, and they're going to move out if they lose money. So like there is some balance there in terms of like health ratios and different things that you look at. But to compare that to multifamily, I live in Cincinnati, Ohio, some of the inner ring suburbs. So I've been active on Bigger Pockets now for years. I got an email literally, I think yesterday from somebody saying, hey, I saw your post on Bigger Pockets. I'm looking to invest in Cincinnati. What are some good neighborhoods? And I'm like, that's kind of the wrong question. I need some more clarifying questions before I can even begin to answer that for you. But taking it at the surface, it's like, I can't give you one, especially where I live and know, because if you look at my zip code, I love where I live. I moved from the same zip code to this house, a whole mile away. So there's 2 areas that I love in, but there's also pockets where you would probably have to give me the house for free for me to even take on the workload that I know that little pocket, that one street back there is going to entail. So you can do the demographic reports, you can do some things, but like you don't really know your tenants because your tenant is one person and that person doesn't exist. We're all special snowflakes. Uh, so versus Chipotle or Potbelly or Starbucks, we're like, okay, cool. Let me review their sales. They're top 10% for the market in sales. They are not leaving. That's a good place to buy. Run the numbers, make sense at this price. We get it. We move on. So that's the long-winded like dichotomy.
Yeah. So, like, I imagine I've heard very similar things, right? Like retail. If you're a retail investor, you understand multifamily apartment buildings because you've probably lived in one. But like understanding a triple net industrial, something or other is not something that you know of, and so it's scary. And so I imagine there's less retail in investors, LPs in like a grocery shopping center than in a multifamily apartment complex.
There are. And again, another reason I've liked this space and kind of chose to come back to it, and part of me finding this was I was starting to look to buy my own retail centers myself. And in that process, sort of found Blackgate, found they were looking for a role that I'm kind of like, I love what I do and I don't have to do it all. So like, let's move into that. It kind of fits a bunch of personal desires all at once. You see less of it. So back to the retail investor, the LPs coming into retail. You see a lot of multifamily syndicators, not all of them, but like you can see it. Like there were a lot of people who were great marketers first, who saw opportunities to make a lot of money in multifamily. And to your point, this is one I was going to bring up, like people pivoting, like from an LP perspective, I love when people know who they are and they stay in their lane. If you're a multifamily operator, you just need to know there's going to be good times and bad times in multifamily, and you're just going to ride those waves and you're going to figure it out and you're going to go through those lean years. But like that's a sign of a true operator to me, who are the people I want to invest in first, versus I'm doing multifamily. No, I'm doing mobile home parks. No, actually, I'm going to start doing some car washes, or I'm going to do this, or I'm going to do that. And I'm like, I understand, like all those are fine investment theses, but like know your lane, because I, as an investor, want an expert. If I want to just like dabble in a whole bunch of stuff, I can dabble myself. I can go try to build a house and buy a small retail center and not fill it up. And like that's dabbling. And you shouldn't dabble with other people's money, in my opinion. You're not going to dabble with my money, I should say. But on the retail side, I was looking at it as not only did I want it, so like that's the kind of biggest desire to move to the role that I'm in now. And you say I've been with 4 groups, and that's true. And I'm kind of like, it's given me a diverse background, but it's not the most proud moment. But it's kind of like finding yourself and finding who I want to be when I grow up, even though I'm 42 years old now. And I'm hoping and seeing a lot of signs of like, this is where I want to be when I grow up. But there's not a lot of marketers from what I've seen in retail. There are some, don't get me wrong, but compared to the world I lived in the multifamily syndication, the bigger pockets ecosystem, in 2021, you would see posts of guys being like, I've been changing tires for the last 2 years. I've never bought a house, but I think I'm going to go raise $2 million and buy an apartment complex. And I'm like, what? I'm sorry, why? Hey guys, I just closed on my first $4 million deal. I'm like, you did what? Like, wow. Like those are the people I don't want to compete with. That's the ocean I don't want to swim in. And, to toot Blackgate's horn a little bit, the founders of Blackgate, for a decade, they were leasing reps for Colliers. It's like they were hired by other landlords, people who owned retail properties, to fill up their spaces. Commission only, just grinding. But like that's where the best operators in I won't say brokers specifically, but like those operators through and through, first and foremost, who become owners, tend to be the best investment managers. And the challenge with them is they tend to not be good marketers. So they're dribbling along, finding deals like, how do we scrape together $2 million? Not, oh, I've got, this arm and that arm, and I run all these different mastermind courses that just feed into this like other group that lets me groom, fund to fund managers to raise all my money for me and blah, blah, blah. And like, I'm just market. I'm going to find money. Oh, now I actually have to run deals. How the hell do I do that? And that's not who I want to invest with. And so for whatever reason, I think the nuances of retail, for the same reason, it's kind of, you don't find as many retail investors in the retail assets. You don't find as many marketers in there as well. So like there's a little bit more, I won't say it's totally blue ocean to use marketing speak, but I like it that way. And then the other piece to it that I've seen is, that's the biggest reason why retail investors haven't seen it. Because I think they're just short of one group that I can think of that is a pretty heavy marketing centric company. The other people that own retail that I know of are just like, they're all friends and family raises. And they've been at it for 20 years. So they don't need to be anything else because they're like, oh, I've made Pascal. He invested $100,000 with me 20 years ago. I've made him $5 million. So every time I have a raise, which is only once every few years, if I do it in a fund model, he writes me a check for $1 million. I have 100 of those guys. So I raise $100 million every 3 years. I go buy the centers I want, and then I go back out and buy some more. It's like, that's the story I've heard over and over again in the retail world. On the flip side, and kind of to your point that you were making earlier, it's because it's so nuanced, because it's like, you need leasing relationships. You need to know how to negotiate leases. You need to know like the construction side and the TI and all these other things that feel a little more nuanced than just like, oh, let me fill an apartment. Let me put new cabinets in. I can raise rents $200 and like fill it again with somebody else. It seems to have taken a lot of that sort of novice investor out. And when I think multifamily syndications, there are some great sponsors out there, very diligent, whether they've got caught up in the past or not, there's still some great groups out there. But the factor is when you have all these novice people trying to scale up a little bit, the guy who's owned a 20 unit apartment is now trying to bid on a 50 unit. The guy who owns a 50 is now bidding on 150. The guy who owns a couple 50s is now bidding on a 300 unit against more institutional players. And they want the deal too. And he doesn't know what he's doing, so he's going to bid it up. And now for me, as the large, sophisticated syndicator, I have to start playing like, do I pay that much, or do I just not do deals? And the right answer is always, you don't do the deal if it's too much. But that's not always the thought process. And so you kind of take that base layer out of just like that feeder system that's going to bid everything up. And I think in retail, probably some truth to this in office, you just don't have as much of that feeder system. So like, you get more competitive bids from sophisticated owners with the same set of facts that to me, I think create ultimately better returns.
Yeah, I mean, if there's less people going in there, right? There's less demand for the given supply. How is I imagine that this is especially true based on how long the firm has been in business, but you've been across four different operators. I imagine each one has their own special sauce or does things differently. And I imagine that's eventually going to get into. I want to ask you about your LP experience, but talk to us about the differences in the four different operating firms that you've worked at.
There's a lot of commonalities and there's a lot of differences. So the biggest, like the most shocking difference that I saw, and again, where they were in their journey. That first company I started at in 2007, they were already 15 years old at that point. So that's older than any other syndicator like I've worked for here, like even up to today, the ones I don't. So that company at this point, I mean, that was 18 years ago. They're 30, they were founded in 92. So they're 33 years old. So they did everything old school. When I started in 2007, we were raising the institutional money, old school, like just, and it was a different era in general. Podcasts didn't exist. Facebook was around, but I think it might still been only college email addresses, maybe. LinkedIn didn't exist. I know that because I signed up for it at the founder's request out to the whole email. Hey, there's this new thing called LinkedIn, and some big oil guy in Texas is on it. Like, you guys should think about signing up. And so the most shocking piece, there are two factors. One is just industry wide, but that company, they had a marketing person. She was a part-time contractor, and she was focused on basically like helping put together the site plans and little marketing pages for the leasing team to fill centers. Investor marketing was all just, who do we know? Dial up the Rolodex. Who are we meeting at conferences? Who does dad know? Who does that guy have as two friends? It was a referral network exclusively. When you got into the institutional world, it was still kind of we're trying to find family offices, and we're getting connections from other people. And I don't know what their official marketing budget was at that first company, but their investor marketing budget was next to zero in reality. Then you fast forward to Ashcroft, and like just seismic shift. Love everything about Joe, who also owns Best Ever, but he comes from a marketing background. And all of a sudden I'm like, wait, you have a marketing team. And that's not even for the properties. That is just for the investor focus side to help me do my job and bring in leads. And, between literally this podcast and his conference, but then outward facing stuff and other conferences we were finding and ways we could get in front of people. Like, it was just vastly different and shocking and kind of eye-opening, because I think a lot of those, kind of going back to like retail as operators and multifamily as marketers, I'm not trying to say that's true in any way, shape, or form. But in my limited instances, and specifically who I was reporting to at Ashcroft, he was a marketer. His partner is an operator. So like, I don't want to label them in a bad light. That's not what I'm trying to do. And it shifted my perspective. Like, holy cow, there's a whole other world out here in this era of how you can approach people. And actually, when I've gone back and talked to friends at that first company, they are publicly traded, but they kind of split. They're still a private side. Like, they're doing a lot more now, or trying to, of what Joe's been doing for the last however many. He's been a marketer forever. So like 20 years, not always in real estate, but in real estate. Like, they've shifted to that, even though they're, the founder's probably a billionaire by this point. Like, they've just done so well for so long that they don't really need to raise money, but they keep doing it because they're trying to build their company as well. So that's been the biggest one. And then it comes down to just different personalities, I'd say. Like, you have some syndicators who are a lot more almost feeling like transaction based. Like, hey, just get the back to my point, like sales oriented, get the money in. That's all I care about. Just get it in, get it in, get it. I'm like, that's not the right fit. This guy wants safety and security and whatever else. And we're buying these like Class C multifamily projects. Like you got to play that match, and not everybody's going to be the right investor. And then it comes down to, the other big shift is like scaling, like how fast do we want to scale? And there are groups out there, and this is not specific to any company that I've worked for, just to be clear. When people look at my LinkedIn later and be like, oh, I wonder which one's this. You hear the rumblings of other sponsors who are like, I want to get to $1 billion AUM in 3 years. I want to be the next Blackstone in 10 years. Like, I'm sorry, you're a multifamily syndicator, and like a okay one, not a great one, not a bad one at best. Like, Blackstone, I love shooting for the stars or shooting for the moon, but there's a fine balance in that. And from me as an LP to transition to that, when I hear those kind of goals, I'm like, that's the wrong measure. Your AUM as a syndicator, and most won't go out there in public. These are conversations you have maybe at Best Ever conference where you're overhearing sponsor A talking to sponsor B, and they're kind of having more of the industry talk than what do I want to present out to LPs. But when I know I play the balance because me as a W-2 employee with syndicators, my career trajectory is based on the portfolio growth. It's performance returns and portfolio growth, as anybody in any company is. So I can't totally discount that, but at the same point, from a pure LP perspective, I'm like, I don't care how fast you grow. I care that you grow my money faster. So I'd rather you have 200 million AUM doing just phenomenal deals, one a year. And I know when I go to Pascal, when I write him a check for 100K, I'm only doing it once a year because that's all the deals he's finding that are going to triple my money in 3 years. Again, making up some absurd numbers. Like to an LP, like that's my preferred route than you being like, oh, I'm going to offer you a deal every month, like clockwork. I've got a new deal going and I'm just buying. I'm buying because I want to hit 2 billion AUM. I want to hit 3 billion AUM. I want to hit 4 billion AUM. Because that's scaling for scale. Like, cool, we can all buy crappy deals and overpay for them to put more zeros on the AUM number. It doesn't mean you're not going to go upside down and be, as you're seeing with a lot, like, they're all going to go crap. That's a possibility if that's the goal.
What so in 2020 you did your first LP deal. You've been in at least 5 deals now. I imagine working at all these different firms has helped shape a little bit about what you've been investing into. And I also imagine the difference between before you did your first LP investment and after you did your first LP investment, there were some learnings in there. So I'd love to kind of like understand, before you made your first one, what was going through your mind? What made you do it? How'd you pick? And then how has it shifted as you've actually gotten more experience directly deploying money?
The first one was, again, a multifamily deal. So I'm living in the space. I'm starting to feel more comfortable with the world. Getting a little bit of wrapped up as like, maybe not like the initial COVID drop, but, quickly coming out of that once you get into the summer of 2020 and later into the year 2020, things were starting to accelerate pretty quick. And you start to get that, like, I better jump on now before I miss out, the FOMO. I don't want to miss this one. This is going to be a great deal. So reverting back to my experience of like literally losing my job because a group got, in hindsight, a little aggressive on assumptions. I was trying to vet for, the talking point at the time, which is conservative underwriting. Every syndicator, you don't hear it as much, probably just because it became so ubiquitous, but like, oh, these are conservative assumptions. Yeah, we're, in the multifamily space, we're expanding the cap rate 50 basis points, 10 basis points per year. This market is showing 8% per year annualized rent growth over the last 10 years. We're only underwriting 5%, this, that, and the other. And it's like, all right, yeah, like that feels conservative. I see where you're going with this. And I've renovated houses. I did the Burr method. Like I understand very tacitly, how when you renovate a project, you can get more rent out of it. So that was kind of the very big picture level. Fast forward, I will say my best investment that I've done has been, it happened to be a retail fund. I don't necessarily equate it to retail per se, because financially it's fine. It's paying me 5% per year, which is their projected, preferred return or distribution rate. Hopefully we hit, net 15 IRR when they exit. But the reason I call it the best one is this was a fund structure. So I committed in late 21, I think I signed my commitment. I didn't fund my final capital call until August of this year. So it was 3.5 years, if my math is right, for them to place, and that they raised $130 million. But these are admittedly older guys, some guys I used to work with at the first company I worked for, and had done well in their careers. And yes, they're going to make good money off this fund. but I call it the biggest one because like they had $130 million to play with. They could have just gone to town and bought and deployed and collected their fees and filled it up and gone out before even things started really shifting and probably raised the next $150 million fund, all before, rates really started skyrocketing in 2022. And they didn't. They were like, this is our criteria. These are the assets we want to own. Like, we're going to be diligent about it. And there's that balance. I'm sitting here like, I've got 50K sitting here waiting for you to call it. Yeah, it's in a money market account making me all like 3%, but it's got to be ready because I'm not going to default on my capital call when it comes. And when I use the term capital call in this situation, this was a commit and call. Like I committed $50,000, they have called $50,000 over time. So like I have no concern that those deals are going to be completely fine long term. I think their portfolios stay like 100% occupancy, and I own 32 assets or something like that. But it's that discipline that they had to look through the hype, to look through all the joy and euphoria in the market when a lot of groups were just out there like, if money comes in, we got to figure out a way to spend it. And they took we have money. We're sitting on this money. It's ready for us to call. And we're not going to buy deals at these prices because they're not going to make sense long term. So that's where I kind of go, like I move into the not quite the institutional level, but just like try to figure that out. Who are the guys who are not growing for growth's sake, but are growing because they are actually finding good deals? And a lot of it comes down to they have like a lot of money in this fund. So it's, even when you net in acquisition fees, I think they're still well into the 6 to 7 or 7 to 8 figures of their own money in this fund. So like they're buying because they're trying to grow their own $10 million, not because they're trying to make $10 million to buy that deal.
What do you think you learned in your first couple deals as an LP? Didn't know being on the other side and raising capital.
I don't know if it happened in the first couple deals, but it was interesting seeing, again, kind of back to that marketing pitch. Like I'm a sales guy. I don't like to call myself a sales guy because I don't really consider myself that. But the job of an investor relations person, that's the title they have in most indicators, is to sell and raise money. They are selling you on the investment, so you write the check. And it was just learning that marketing speak and learning how operator, when you get presented the deck as an LP, that deck has been scrubbed several times over. The deal before had the niche score for that school, that local school. This one doesn't. They intentionally didn't put that in there. Like that's not an oversight. That's that doesn't look good. Like, take that out. What's a better selling point that we can throw into this? So it was seeing that process. And I don't want to say I'm sure there are groups that are more nefarious than others with it. Who I was working with over the years, I don't feel like was ever necessarily nefarious about it. But it is the point, like at the end of the day, like those decks are to urge you to want to invest in the deal. And building a case as to why not just this deal, but this asset class, everything else fits and is the best risk-adjusted return for your money. So like that was a big realization. And it even took a while. Like even as I'm getting called into meetings and part of that review process of like, hey, we need to reword this. Hey, we need to change that. I was part of the system, admittedly. So again, not trying to be anything nefarious, but trying to ease my job a little bit.
An investment. It's a product.
Yeah. You're not lying about anything, and the other one is you're gonna get. I shouldn't say the worst question you can ask. It's definitely not that. But as an investor, there's almost no point in you asking, what should I have asked that I didn't ask? Because that's like admittedly asking for referrals. You think if I have a pissed off investor, they're going to go on my referral list to send to you? And like, that's not syndication of any business. No, they're not. I'm going to give you realistic ones. I'm going to not overhype it. Again, back to that marketing side. Like, I want to give you some where people are like, yeah, it was fine. Because if you call them, I don't want you to think like, oh, you only gave me the best of the best. I want to like feed in a little bit of honesty in there. But I'm not going to give the guy who's like, we had to buy him out because he was so pissed.
Right.
And it might not even be, again, one to use that to kind of defend myself. There was a guy who was just thought he was going to get more on his K1, more losses on his K1 than he got. And like, we didn't promise anything. We didn't tell him anything. We kind of directed him as to historic averages. I personally directed him to historic averages. That's it. He got his first K1 and it was like half of that. He's like, this is not what I was told. And it's like, fine, you're out. Here's your check. We'll take your thing. See you later. So I'm not saying it was it doesn't necessarily need to be a performance issue. It was that. And, but I'm not going to send him to you the referral. So when you're asking questions, I'm going to answer all of your questions, and any good IR person should, to the best of their abilities, to honestly, first and foremost. What I always valued in those training people that were reporting to me, I'm like, an excellent call, like the best call you could have is when somebody gets to the end and they're like, you've answered all of my questions. And not only have you answered them all, you've answered them all directly and honestly. And I was like, so that's like gold star. Very close to gold star, and probably better gold stars. If you don't know the answer, you're going to look it up. You're going to follow up with them in a timely manner and get them the right answer. You're not going to make stuff up for them. But it's like, if you're not asking a question, if you look at my track record and say like, hey, have you ever lost money on a deal? Well, no, I haven't. What about all these deals that I'm reading about online with capital calls and stuff? I'm like, we haven't lost that money yet. Again, like, not an answer I'm having to make right now, but like, that would be an example. I'm answering your questions. You asked it. Honestly, it doesn't mean I need to layer in more to unsell you about things that don't paint us in the like shiniest light. So it's like you have to really think through your answers.
Your questions. You have to think through your questions.
Sorry, correct. Your questions.
Yeah, totally.
One that I always advise people whenever I'm having these kind of conversations is ask about current deals, current operations to pro forma. Because I've seen and heard of people where it's like, well, how are your deals doing relative to budget? Well, here's the inside lingo. Budget is reset. It's set each year and then it's reforecast throughout the year anyways. Budgets move. I don't care. Because you could make your budget artificially low to be like, oh, we're outperforming budget 20% across the board. Great. I want to see your initial underwriting that you put in that investor deck, whatever you call that, pro forma, initial underwriting, whatever it's called, and everybody's going to have a different one. How are you performing to that? Because that's where it's going to give you, again, in today's economy, like real insights. And it's also, as an LP, you need to know to not ask, how are deals performing to budget? Because they can honestly answer that with whatever that number is, but you have to, it's the lingo side. And I'm not trying to hide. I've never gotten asked that question. And I should say never, when I have, I'm like, do you want budget or do you want pro forma? Like, because I think I know where you're going with this, but what you're asking is the lingo that we use not going to get you the answer you're looking for or the type of information you're looking for. So it is a deep dive. It's why this show is important, because you need, this podcast. It's like years ago, I'm sure this is a tangent of the active passive investor. Like, you got to know what the industry is talking about to be an LP, especially if you're an LP like me, who's like, yes, I'm an accredited investor, but I'm not a qualified purchaser. Like $150K investment a year, maybe two, if I'm using fresh money. Other than that, it's cycling investments. I have to wait for that syndication to sell before I've got free up, hopefully some money plus some to go into the next one. Because even if you're making $400K a year with 2 kids and, a couple vacations and maybe private school and 2 car payments, like in reality, having $100K after tax to invest every year on that salary is a stretch, So that's kind of where I will leave that comment.
Evan, this was incredible. Loved digging in. I think we had a real solid conversation. Loved every minute of it. Where can people go reach out to you online?
So the easiest place is LinkedIn. Thankfully, I have a relatively unique name. I think I'm the only one that's going to come up, and my picture looks kind of close to this. If you're looking for information specifically about Blackgate, go blackgate.com. So G-O, the color black, the gate that goes on your front door.com. And there's a contact us form to throw in your information. We'll reach out that way as well.
Hell yeah. Hey man, I appreciated having you on. Guys, if you are interested in deals like the ones that Evan and Blackgate put together, I'm going to try and get Evan to send me his registered offerings so we can add them into our database. But if you're looking for a deal flow to invest in these private deals, I highly encourage you to go to passiveinvestingstarterkit.com. And you'll get all the deals that I see across my desk, and you get new ones every Friday. Again, if you are interested in leveling up as an LP, highly recommend the Best Ever conference that's happening in February in Salt Lake City. And, we do this show every Thursday. If you want more interviews like this, be sure to tune in every Thursday. I've got the Passive Income Playbook. Don't forget to reach out. Let us know if this impacted you, what you might have taken away. And don't forget to subscribe and leave us a review if you enjoyed it. Again, this is Pascal Wagner, and this is the Passive Income Playbook, part of the Best Ever CRE show. Thank you so much.